Have you ever wondered how a global war, one of the deadliest conflicts in human history, ended up being one of the most important moments for banks? It sounds paradoxical. War destroys, war kills, war devastates economies. And yet, for banks, especially in the United States and Europe, World War II was not just a catastrophe, it was a financial lifeline. Tonight, I want to take you on a journey through how banks literally needed World War II to survive, rebuild, and even thrive. Let's start in the late 1930s. The world was still reeling from the Great Depression. In the US, millions had lost faith in banks. Thousands of banks had failed in the 1930s, trust was shaky, and lending was weak. Meanwhile, in Europe, political instability and the scars of the First World War made banking fragile. Many financial institutions were struggling to lend, to find liquidity, or to maintain solvency. This wasn't just about war looming on the horizon. Many banks were on the edge of collapse already. Then came the war, and with it a desperate, unprecedented need for money. Governments needed cash, vast sums to build tanks, planes, ships, ammunition. They needed to pay soldiers, buy fuel, supply food. To fund all this, they turned to a tool that would become central: war bonds. But war bonds didn't just raise money, they reshaped the banking system. Here's how it worked. The U.S. Treasury, together with the Federal Reserve, launched massive bond drives, organizing what were called victory loan or war savings bond campaigns. The goal? Entirely mobilize the home front. Ordinary Americans, from factory workers to homemakers, were encouraged to buy these bonds. But they weren't just selling these bonds directly. They leaned heavily on banks to act as intermediaries, underwriters, and distributors. Commercial banks took on this mission. That meant they weren't just passive bystanders. They became active agents of war finance. They bought war bonds themselves. They sold war savings bonds to their customers. And they used their networks, branches, and marketing muscle to drive bond sales. By the end of 1945, 57% of total U.S. bank assets were held in government securities. Think about that for a moment. Over half of what many banks owned was now U.S. government debt. That's a huge repositioning of a bank's balance sheet. Loans to businesses or consumers faded into the background. Instead, the risk profile shifted heavily to government securities. And for many banks, that shift was the difference between collapse and survival. But why was that so powerful? Because bank lending in normal times carries risk: default risk, business downturns, consumer risk. During wartime, however, government debt, undergirded by patriotic campaigns, central bank support, and sheer necessity, became relatively low risk. The government was backed by force, by national policy, by mass mobilization. For banks, holding war bonds was not just safe, it was essential. Meanwhile, the Federal Reserve played a critical behind-the-scenes role. The Fed wasn't just a regulator, it was a co-architect of the war financing effort. The Fed agreed to keep interest rates artificially low, sometimes pegged at a fraction of a percent, to make it cheaper for the U.S. government to borrow. The Fed bought Treasury securities, helped manage liquidity, and allowed banks to channel enormous volumes of deposits into Treasury debt. That tripled the money supply between 1940 and 1945. In practical terms, that meant banks could funnel customer deposits from business accounts, checking accounts, savings, into government securities while still having access to liquidity. Depositors weren't withdrawing cash furiously because the war mobilization fueled business activity. Factories were running, payrolls existed, and unemployment dropped. Bank failures were rare. In fact, from 1942 to 1940, the number of failed banks dropped dramatically. In short, the war created both a liquidity tsunami and a safe asset glut. Bank balance sheets swelled, their assets became more liquid and more secure. The war didn't just hand banks a new business line, it gave them a structural transformation. But banks did more than just passively hold the debt. They participated in the underwriting and the distribution of war bonds on a massive scale. They helped connect the government to retail investors. Through branches, they sold war bonds. Through publicity, they drove patriotic campaigns. And by doing so, they embedded themselves deeply in national policy. In some ways, this made banks more systemically important than ever before. Why? Because governments needed them. Without a network of commercial banks to distribute war bonds, the U.S. Treasury would have had a much harder time raising money. The banking system became a fiscal agent for the government, a core part of war finance infrastructure. At the same time, depositors, ordinary citizens, were incentivized to put their money into war bonds rather than leaving it idle in banks. That freed up bank capital even more. Banks could mobilize those funds, reinvest them into war debt, and operate with a cushion. It was a cycle. People bought bonds, banks underwrote and held debt, and central banks supported that debt with liquidity. But this story doesn't just play out in the US across the pond. In Britain and other allied countries, banks were making the same transformation. British banks dramatically raised their holdings of government debt during World War II, and the war reshaped their balance sheets. European banking systems were transformed. More government debt, more deposits, more scale, and more integration in national planning. This war-driven concentration of bank assets in government securities not only ensured their survival during wartime, it reset banking for the post-war period. After the war, banks didn't just go back to their old business. They emerged leaner, more liquid, more trusted, and deeply entrenched in national finance. Many banks that survived the war consolidated, weak institutions merged or closed, but those that remained were stronger. Now, at the same time, there was another institutional force that supported banks, the Reconstruction Finance Corporation, or RFC. Originally created to stabilize banks after the Great Depression, the RFC expanded during World War II to finance war industries, offer loans to companies producing weapons, and provide credit to vital defense sectors. That meant banks weren't the only players, but they were crucial partners in funneling RFC capital into war production. Imagine a bank in 1943. It's selling bonds, holding huge amounts of treasury debt, supporting industrial loans, and working alongside the RFC. It wasn't just in the business of deposits and loans anymore. It was in the business of national survival. From a risk perspective, this realignment dramatically reduced credit risk in the system. Business lending, consumer lending, yes, that continued. But for many banks, the bulk of risk now was on government debt. That meant fewer loan losses. Loan losses were practically non-existent during the war years. This wasn't by accident. It was built into the structure of war finance. As a result, bank failures plummeted. Between 1942 and 1945, only 28 FDIC-insured banks failed in the U.S. Great stability for an industry that had been so fragile just a decade earlier. Let me also point out something else. Wartime finance forced banks to scale. Banking operations expanded. Central banks hired thousands of new people. The Fed itself organized committees, war bond drives, and worked closely with regional banks to mobilize public participation in bond campaigns. The Chicago Fed, for example, became a hub of regional war finance operations. This scaling gave banks more capacity, more human capital, and more network infrastructure. After the war, they didn't just shrink back. Many of them kept that capacity, and they used it to finance post-war growth, rebuilding cities, consumer credit, mortgages, and the booming industrial economy. And don't forget, bank legitimacy skyrocketed. By being central players in a national war effort, banks weren't just asking for deposits. They were seen as patriotic pillars, working hand in hand with government. That earned them political capital. But the war also shifted banking risk models and balance sheet composition long-term. Before the war, many banks focused on lending to business or making consumer loans. After the war, a big part of their assets remained in government securities. These war bonds evolved into peacetime treasury bonds, savings instruments, and long-term government debt. This persistent exposure to government debt meant banks became intrinsically tied to national macroeconomic policy, a transformation that shaped banking for decades to come. In Europe, the story was similar but more dramatic in Reconstruction. Post-war, infrastructure loans, reconstruction projects, and the rebuilding of industrial capacity all ran through banks. Those banks didn't just survive the war, they became engines of reconstruction. In addition, globally, wartime realignment of finance helped reshape currency systems, too. After World War II, the Bretton Woods system was established, pegging global currencies to the US dollar and effectively making US banks more influential in the global financial order. American banks found themselves operating in a world where the dollar dominated and foreign governments held huge reserves in treasuries. In short, US banking institutions went global, and their role in financing the war made that possible. Now, it's also important to note that this wasn't some exploitative ploy by banks. Banks weren't simply profiting from conflict in a vacuum. Governments needed them. Yes, but banks also made a genuine bet on their own survival. They repositioned their balance sheets to ride the tsunami of government debt, and they bet that governments would honor that debt after the war. They bet that depositors, war bond investors, and the public would continue to trust them. And those bets paid off. When the war ended in 1945, banks didn't just unwind everything and go back to 1930s business as usual. No, they walked into a post-war boom with enormous balance sheets, new capacity, and a redefined role in national finance. They were ready to finance consumer credit, housing, business reinvestment. Many of the modern banking giants of the late 20th century trace part of their strength to that war-era transformation. In short, World War II was not just a crisis for banks. For many, it was a turning point. It provided capital, liquidity, legitimacy, scale, and a new operating model. Without World War II, many banks might have struggled to survive the 1930s. With World War II, banks not only survived, they reinvented themselves. If you've stayed with me this far, you're probably starting to realize just how seismic this shift was. But the story doesn't end when the war ends, because the war's impact on banks continued to reverberate for decades afterward. So let me carry you forward through how this wartime transformation changed banking, finance, and the global economic order. Immediately after 1945, the world entered what many called the Age of Reconstruction. Europe and Asia lay in ruins, factories destroyed, infrastructure decimated, people hungry, governments desperate for capital. But guess who was ready to step in? The banks. The same banks that had underwritten war bonds, that had hoarded government debt, that had scaled up massively. They were now deeply embedded in rebuilding national economies. In Europe, banks directed huge sums into reconstruction efforts. They issued loans for infrastructure, for roads, railways, housing. They lent to businesses that needed to rebuild. They financed companies that were retooling from war production to civilian goods. This was not small-scale lending. This was reconstructing nations, and banks were at the core of it. Meanwhile, in the US, banks were financing the post-war boom. Mortgages for returning veterans, business expansion, the rise of consumer credit. With their wartime balance sheets flush, banks had both the capital and the stability to lend aggressively. Suburban housing exploded, manufacturing boomed, and credit fueled a golden age of growth. For banks, this was a dream. Large-scale lending with relatively low risk, backed by a booming economy. On top of that, many banks continued to hold large volumes of U.S. Treasury bonds. The government didn't just walk away from debt, it rolled some of it, it refinanced, and the bond market remained a core business line for banks, even in peacetime. So their asset mix, the proportion of safe government debt, continued to anchor their balance sheets. But more than assets, banks also gained reputation capital. Having played a key role in financing victory, they were now trusted institutions. Depositors believed in them. Policymakers believed in them. Their role in economic mobilization elevated their status. That reputation translated into political influence and regulatory leverage, which they used to grow in a reshaped financial world. At the same time, risk models within banks evolved. The shock of war had taught them hard lessons about macro risk, about liquidity, about sovereign exposure. So, many banks adopted more sophisticated approaches to risk management. They didn't simply rely on collateral. They looked at macro debt risk, interest rates, liquidity, all of which had proven critical during the war. This made them more resilient for future crises because they had practiced on a crisis unlike any other. But that story isn't purely domestic. World War II's war financing also gave rise to a new global financial architecture. Toward the end of the war, leaders met in Bretton Woods. The Bretton Woods Conference established a system where currencies would be pegged to the US dollar, and the US top dollar itself would be convertible to gold at a fixed rate. That meant global central banks needed dollars. And where were those dollars coming from? From US Treasury debt, the same bond market that banks had helped build during the war. This arrangement made the US dollar dominant, and it gave American banks enormous global reach. Foreign entities bought US debt, Governments built dollar reserves, and U.S. banks became central in global finance. The war had laid the foundation for America's financial hegemony, and banks were the pillars of that structure. In Europe and Asia, rebuilding banks meant rebuilding trust. Many war-torn countries restructured their banking systems. Some banks were nationalized, others reemerged as powerful institutions in a new world order. Reconstruction loans flowed through banks, credit lines were extended, private and public finance fused, and banks became the agents of national economic rebirth. But with all this power also came political consequences. Banking institutions became more influential in public policy. Governments recognized that banks were not just economic intermediaries, they were strategic partners. That raised regulatory risks, social tensions, and debates about banking's role in society. The war had empowered banks. Now the challenge was to balance that power with accountability. Let's also talk about inflation and monetary policy. The war years saw sharp changes in money supply. The Fed and other central banks had to carefully manage inflation risk because of the huge expansion in debt and liquidity. But after the war, banks had to deal with inflationary pressures, monetary normalization, and the risk of interest rate shifts. Their wartime balance sheet had been built under very unnatural conditions. Peacetime risk was a very different game. Another long-term effect, deposit structure deeply changed. During wartime, many deposits shifted, liquidity preferences changed, and customers became more risk-averse. This altered how banks funded themselves long after the war ended. Now let's layer in one more dimension, moral risk, or too-big-to-fail risk. The war made banks systemically important. Governments leaned on banks for war financing. Banks held massive government debt. The notion that a bank failure could derail national security became real. That implicit guarantee became a powerful safety net. In other words, war made banks too central to fail. This is a risk we still reckon with today. And there were cross-border effects too. The scale of finance required for war and reconstruction pushed international banking integration. Global capital flowed into Europe, into reconstruction projects, into trade. Banks became conduits of capital, not just within their countries, but across borders. This set the foundation for institutions that financed globalization in the decades that followed. Let's not forget the human component. The war also forced banks to scale operations quickly. New staffers were hired, branch networks expanded, administrative capacity increased. After the war, many of those employees stayed. Many of those branches remained. The banking infrastructure that had been stretched during crisis now supported a peacetime boom economy. At the same time, banks handed much of their wartime mission to a new generation of finance. What had been seen as patriotic duty became a business model. Underwriting government debt, managing public savings, distributing securities, these became core institutional functions. And in many ways, the war anchored banks more deeply into national economic policy. Fast forward decades after the war, the banking system that emerged was very different. It's more centralized, more integrated with the state, and more capable of handling systemic risk. Modern banking giants trace part of their DNA back to this war-era transformation. So what's the takeaway here? Why did banks need World War II? Because the war offered them a capital reset, market turmoil turned into liquidity, a risk transfer, government debt underpinned their balance sheets. Scale and legitimacy, they became essential to national survival. Strategic importance tied into government policy, political power, and global influence. Long-term growth, from war bonds to mortgages, reconstruction financing to global finance. Without World War II, some banks might have collapsed in the 1930s, or at least remained much smaller. Instead, they came out of the war not just surviving, but reborn. They became institutions that could finance peace, reconstruction, and the modern capitalist world. In the end, World War II didn't just reshape geopolitics, it reshaped finance. And banks didn't just help win the war, they won a new war of economics. Their survival depended on it. And the banking system we know today is still built on that wartime transformation.